Everyone. Dom, thanks very much. Now, as mentioned, we got some key economic data this morning, some leading indicators on the economy as well, and they didn't come in that great. Jobless claims soared to almost 250,000 last week, the highest since last August. The jump in claims setting the 10-year yield to 4.1% and then below 4% on weaker manufacturing data for the first time since February. And with concerns rising about a slowdown in the labor market, especially after that ugly ISM employment print, my next guest says tomorrow's big jobs report will be a crucial piece in determining where the economy and rates go from here. Joining us is Larry Lindsey, CEO of the Lindsey Group and former director of the National Economic Council, a former Fed governor as well. CNBC senior economics reporter Steve Liesman is also with us. Larry, a belated happy birthday to you as well. It's great to see you. Thank you for joining us.
Thank you.
And listen, there's so many global developments that I would like to kind of bring this conversation back to. But let's just start on what you think is the bread and butter of what's going on with the U.S. economy here. Are we slowing?
Well, the word slowing has to be used with care, because remember, we were growing at over 3%. So yes, we're slowing from 3%. I would say we're growing, right around 2. I think we had a number in the high 2s probably coming in for the second quarter. Current quarter, third quarter, looks to be about 2. So yes, we've slowed from 3 to 2, but the Fed's view of the long-term trend is 1.8. So, slow, yes, but too slow? Absolutely not.
I've been watching commodity prices with interest and gold as well. So gold's breaking out. Oil now is not breaking down the way it was because of the Middle East developments. But commodity prices have been plunging because of what's going on with China in particular, kind of continuing to export deflation. What does that tell you, Larry, and how should we expect that to affect the U.S. economy?
Well, I do think it's helping out quite a bit with regard to reducing inflation. Given the level of aggregate demand in the economy, we should be having inflation higher than what we have. And what brought it down, and here by aggregate demand, I'm talking about real final sales to domestic consumers. The thing that's weakening our demand is a lot of that's imports. And imports have been surging, and that is helping to hold down the inflation rate.
So say that one more time, because this is not something that I had on my bingo card. In other words, Americans are buying too much cheap stuff from abroad, and just talk me through that.
Sure. So first of all, the wealth to income ratio is at historic levels right now. When people are wealthy, they don't feel they have to save, that they can spend. So the spending rate out of income is very high. That means there's a lot of demand out there. That shows up in something called final sales to domestic purchasers, which is down a bit in the weeds in the GDP report, but it's going gangbusters, okay? The reason that's not reflected in, say, the GDP numbers is that if I can buy something, and that's a high number, but if what I'm buying is an import, it doesn't show up in GDP.
Right.
So that's holding down the GDP prints. We actually have very strong demand by domestic consumers right now, led, by the way, by the government.
It's Shein and Temu, Steve. It's all their fault. Otherwise, we'd have a gangbusters economy, and they're exporting deflation around the world. Steve, can you address the question? Piper Sandler this morning, I think it was Nancy, said, we're not seeing good disinflation. We're seeing the kind of disinflation that's coming from a slowing labor market. So I'm trying to decide whether we can celebrate these developments and lower bond yields, or if we need to be very concerned about them. Steve.
Well, I think it's for the Fed, it's how they don't much care how you get there as long as you do get there. We did have disinflation from the recovery of the supply chain. Some of that still remains, but that's had pretty good healing to it. And they needed more, and they still need a bit more. And there are not that many places to get it from. The supply chain may have given all that it could give, and then the rest of it needed to come from someplace else. I would point out among the numbers you talked about, the one that caught a lot of attention of a lot of economists this morning was the ISM manufacturing index employment component down to 43. And we have not been that low since we were coming out of the retrenchment from the pandemic. So that's an ominous sign. Some of the other high frequency data I look at, For example, Homebase is also not looking that healthy. I would be a little bit careful here. It could be a summer swoon. It's entirely possible that you have a little bit of a break in the torrent pace we've had in hiring. I wouldn't necessarily start to man the lifeboat, so to speak. But what we are looking at right now, which is the sort of a paradox of all this, Larry gave a number of we're growing at 2% now. A lot of folks were upgrading their GDP forecast for the third quarter. Obviously, not a whole lot of data at 2.5%. So the GDP numbers seem to be okay. Perhaps it's powered, Kelly, by some of the wealthier consumers out there and some other things that are going on in the economy. But right now, the GDP numbers look good. The concern at the Fed, the concern among several economists is that there's some deterioration underneath.